I'm gonna keep yours too.
I'm
No,
gonna accidentally pass yours out. Just kidding.
Yeah, that's okay.
it is a,
Little cute, like 2-page
oh, you
update
did.
on there.
Awesome.
Very cool.
So, I don't know if you know this, but if you use Chrome browser, any web page that you come across, that you can right click and get a QR code. So that's a way to create a QR
Okay,
code if
that's
you want,
cool.
you want somebody, because that's kind of a cool way
Mhm.
to present material instead of like a bunch of pages or whatever.
Yeah, and then it's not like in your face, cause I, you
And
know,
now you can throw your cards in there.
that's why I waited, cause I wanna
Oh,
put the
perfect.
cards in there
Yeah.
too.
Does anybody need anything before we get started? Coffee, water,
I think I'm all right.
shot,
Okay.
beer?
Yeah.
Well, if you're offering.
Well, I mean, hold on, hold on. I said I was okay before.
You have a beer, you have some beer left over from the
Probably
other
do.
day.
Probably do. The refrigerator's usually got a variety of things.
Well,
And
without
you're
further
No,
ado,
you're fine.
welcome Tony Abate from Ross Mortgage.
Thank you, thank you, thank you, thank you. So, welcome, everybody. This is probably one of the favorite things that
Stop, wait a minute, did you hit the record?
I hit record.
Okay.
Yeah. Okay, we'll start over for the Zoom participants, but I love doing this because, not only is it just, an opportunity to create relationships, but, it really just kind of gets some cool dialogue going. We all think of sort of what if situations that we run into, or, hey, I heard this, or I saw this online or whatever. And so the purpose of this really is not to turn anybody into a mortgage expert. I mean, that boring part that's my job. But, needless to say, unless you're blessed to have nothing but cash buyers, doesn't happen a lot, right? But it happens. What's that?
I've had a couple.
Yeah. Then you're gonna be interfacing with the mortgage piece, needless to say. And for better, for worse, in the eyes of the client, you're in charge of the deal. And if something goes right, you get the props. And if something goes wrong, you take the heat, even if it's not your fault, And so when we talk about the things to know on the mortgage side, it's not the idea to again turn you into a nuts and bolts expert on the mortgage side, but it's where do we come into the conversation? What can we do? Where do we all fit in together in making that customer experience turn out right? So that's what we're going to do today. And then throughout the year, we do just regular sessions on topics. It could be on a variety of things. I think the last one we did was on appraisal guarantee. I think we zoomed that one, but I was in Clinton for that because that's a hot topic right now. People are needing to write appraisal guarantees in their offers. Now everyone kind of gets it, but it's like, well, how do we put this in the offer? So we'll do presentations on just closing costs, on the mechanics of the mortgage, on things that are good foundational things to know, but then also things that are relevant to what's going on in the market at the time. Okay. Okay, so a little bit about us. So Ross Mortgage is by definition an independent mortgage bank. Okay, and so buyers are going to get their mortgages from one of three 10,000 foot view sources, if you will. There's independent mortgage banks such as us. There's the savings and loans such as the Chase and Fifth Third and what have you, and then you have the mortgage brokers. Think of a mortgage broker off the top of your head. That might be household name. UWM is the wholesale.
UWM uses like simple lending.
Right, simple lending. Yeah. So a broker is the fancy people in finance call it arbitrage. They basically bring parties together. Okay. They're not lending any money. They're finding a buyer, and then they're finding a lender, and they're marrying the two together. Okay. Now, back when there was 31 flavors of different kind of mortgages, that type of relationship had a different benefit because there were so many different things for a buyer to choose from that a mortgage broker kind of helped navigate those choices. Well, now post-recession, the world's a little more vanilla. We've got our conventional stuff, we got our government stuff, we got a few non-conforming things, but it's a world with far fewer choices for home buyers than what it used to be, which is a good thing because folks got into some serious trouble by getting into mortgages that kind of backfired on them pre-recession. So, of those three types of lenders, of course, I'm going to be biased, but I think we offer the best of both worlds. We're aligned, I think, at last check with 17 different large banks and servicers where we can obtain funding from, but it's a Ross mortgage loan. So we originate it, we process it, we underwrite it, approve it, close it, fund it, the whole 9 yards. It's Ross mortgage from start to finish. Okay. And then as a matter of practice, like most lenders our size, we'll sell the servicing component of that mortgage to a larger entity after the closing. Probably happened when we did
Yeah,
yours, right?
yeah,
So we are a licensed servicer. And by the way, the servicing component is the payment management piece of the mortgage. Okay. So we might collect a payment, maybe two, and then we're going to transfer that loan. But by that point, everything is already done. Okay. So we offer, a great deal of control over the transaction, since we're handling everything up to and through the closing. So if something is a little funky on a deal and we need to work something out, I just get in my little car and drive to our Troy headquarters and sit down with our CEO or our underwriting manager and say, look, we got to find a way to get this one to the closing table. And it works. We can put those things together. So I'm not going to be reading these slides verbatim, by the way. We're not going to be that formal in this. So Ross Mortgage, though, goes back. Next year, we're going to be celebrating our 75th year in the business.
Wow, really?
Yeah, 75 years. I did not.
Didn't start it?
I was not with his dad did.
His dad, I was gonna say, he's not that old.
Right. Yeah. So Tim Ross, our CEO, the company was founded by his father, Hugh Ross. They're both pretty much icons in the business. Whenever I'm at a function and I introduce Mr. Tim Ross to somebody, invariably he's already known that person for the last 20 years, and I slink back to my corner and stay out of the way. But it's very much a purchase-centric lender, in that the majority of the business that we do is purchase transactions, and the minority of the business that we do is refinance transactions. Of course, we do them when the need arises and when the opportunity arises, mostly for past clients, but we're really all about the purchase business. And one of the few local lenders that are as old as we are, being based here in Southeast Michigan. So we're pretty proud of that. In fact, next year, to celebrate our 75th anniversary, we're spearheading an initiative we're going to donate a home to a disabled veteran's family. And you're going to hear more about that because of our partnership. We're going to be involving Century 21 as well. So just a little bit of a sidetrack. Whenever, my role to a great extent is selling as well, right? I want realtors to refer business to me. We want buyers to use us for the mortgage services. But I've never been comfortable selling from the standpoint of calling somebody up and said, anybody who wants to finance their house, right? But if you can call somebody and provide information, provide a snapshot of the market, provide, maybe an explanation of what's going on that's front and center in the media, it's a good thing. So with this initiative that we're doing, you'll have an opportunity to call people and say, hey, just so you know, we're partnering with our friends at Ross Mortgage. We're giving away a home to a disabled veteran. Here's some things that we're doing. So we're going to be doing fundraising events and stuff like that along the way. So more to come. Okay, so some of the things we do as an independent mortgage banker: same-day pre-approvals. We're going to talk about that a little bit. We do specialize in FHA and FHA 203K loan programs, which is a renovation program. And by renovation, that means that somebody could combine the purchase of a home and the improvement of a home all in one transaction. You think about that home that might be on the market, the windows are shot, the roof is shot, or maybe it's just dated and needs some cosmetic TLC. That the cost of that improvement can be folded into the purchase mortgage if somebody wants to do that. Probably most important, we close loans on time every time. This goes back to what I was telling you all about, how your reputation is at stake, whether or not you're responsible for something or not. And we get that. We take that very, very seriously. And part of that is closing those loans on time. One of the things that I'll tell folks in a transaction, I don't mind waiting on you. I just don't want anybody waiting on us. And that's the way we try to roll. We educate borrowers through the process. Looking at real estate's an exciting thing to do, but most consumers have a certain amount of knowledge, but not tons of knowledge about the process. And you don't want somebody to be discouraged from the home buying process. You also don't want them to be misaligned as far as the price that they're looking at homes. If they want their payment to be here and they're looking at homes that's going to give them a payment here, something's not going to work. The education piece also speaks to the mechanics of that closing and how does it go from start to finish. I know when we closed your home, we had a lot of conversations along the way, right? Because there's things to know. And we operate.
Excellent, by the way.
Oh, thank you, Sean. I appreciate that. I financed Sean and her husband's home, by the way. It's been a while. It's been how long?
3 years.
3 years. Okay. And folks are getting ready to spend an awful lot of money right? And so they kind of need to know. And you don't have to go too far to hear peers or friends say, yeah, I had my closing. I signed a bunch of stuff. I didn't know what the heck I was. And we don't want clients to feel that way, right? We want to make decisions based on knowledge. And we play a role from the financing to help educate buyers on that. We maintain control of every phase of the mortgage transactions. What I was speaking about before, as a mortgage banker, we have that luxury of saying, we've got this thing from start to finish. I'll joke with customers, you're stuck with me. You know, you're going to only hear from me from beginning to end. It's not press 1 for processing, press 2 for closing, or anything such as that. Different by design and successful with teamwork. And, you know, we're very, very proud of that. You know, the operations side of our business, the processors and the underwriters, they're on the same page and the same teams. How can we get this transaction to work and get it to the closing table? You know, one of the things that we're sensitive to is when you refer somebody to us, we're kind of held to a higher standard, you know, because as an industry professional, the assumption from the consumer is you're connected and you have some knowledge of companies that are good, companies that are bad. You're not going to steer customers in the wrong direction. Okay, so top 5 reasons to get a mortgage pre-approval. I'll back up for a step though and provide a definition because the word pre-approval and pre-qualification, unfortunately, are not regulated terms, okay? And what we call a pre-approval and what the next lender up the street is going to call a pre-approval may not be the same thing, okay? In our world, a pre-approval is a full-blown mortgage application, fully documented income, assets, credit, underwriting review, the whole 9 yards. There's just not a property plugged into the equation. Okay, so what does that do? Number one, it ensures that we're working with a buyer that's truly committed because we're going to put them to work. And if they don't want to do that, you probably don't want to waste your time with them because they're probably just kind of kicking tires. The other thing it does is it avoids surprises and makes sure that they know exactly what's going to happen. And it makes sure the transaction doesn't have any glitches too. Oh, we didn't know this about their bank account. Oh, we didn't know this about their income. We've got all that stuff before they sign the purchase agreement. So that's a pre-approval. Now, pre-qualification in our world is an analysis, okay? It's, hey, what's your income? What's your debts? How much is available for the down payment? Great. You qualify for homes in this price range from A to B, okay? And that's, you know, nothing's validated, but that doesn't make it a poor place to start. I mean, it at least helps somebody find out, yeah, I'm in the hunt. This is making sense to me. But we don't go to bat and present an offer based only on a pre-qualification. Okay, you want that buyer to be fully pre-approved. If you have listings and you're looking at a lender's pre-approval letter, you know, on the phone and grill that lender and say, tell me a little more about your pre-approval. Have you validated this? Have you validated that? And so on. We'll talk a little bit more about that. So top 5 reasons. Realtors will see you as a serious buyer, save time by looking at the right homes. I'm going to go back to number 1. If you can use us as a filtering mechanism for your prospects. And part of that filtering mechanism is if somebody wants to see homes, but I don't want to give the lender my pay stubs yet and bank statements and what have you. You have to kind of evaluate their seriousness and commitment to doing the thing. What's the average time on the market, Steve, now with the listing?
I mean, it's going up.
Okay.
I mean,
it's all relative though, isn't it? Because it's
still under 30 days.
Yeah. So it's no secret. It's a seller's market. Things are moving quickly. A buyer has to be prepared. They've got to be, you know, and there's more buyers and properties out there right now too, right? So we want to help them be prepared. Save time by looking at the right homes. When I'm working with buyers, I like to look at qualification in 2 ways. The first is, you know, that literal mathematical qualification. How much mortgage can be supported by your income and your liabilities? Okay, and that you know, puts a line in the sand as far as their maximum. But the other practical part of that conversation is, Mr. or Mrs. Buyer, what do you want to have happen? You know, do you want your payment to cap at a certain level? Do you only want to use 70% of your savings? You know, so those kind of things become the real limits for that buyer. Okay, so we want to have a connection between the price of homes that they're interested in, the monthly payment that they're going to have when they select that home, and having the right amount of assets to close on the transaction. So that's something that happens pretty early on in the stage. We don't want somebody looking at homes that's going to give them payment here when they want a payment to stay here. Because now you got to go back and show them homes that cost less.
Mhm.
And what do you think that happens if you're car shopping, you start at the
Right.
Cadillac dealership, right? None of the other cars are gonna look as cool, right?
Yeah,
Yeah, so we want to get them calibrated right from the get-go. Gain confidence and avoid disappointment. To consumers, the finance and the real estate process is murky. And it's a little bit scary, needless to say. So we spend a lot of time walking them through the process. In fact, we've got a very good home buyer guide that I'll make sure that y'all have and can put on your desktop to send to buyers. You need to know how the process works, right? And then enjoy a faster closing period. Okay, pre-approved means we got everything done in that finance piece except for vetting the property, appraising it, and doing the title search. Okay. Okay. Here we go. So this is going to be a little bit redundant, but mortgage pre-approval, we're going to run a person's credit to ensure the borrower has qualifying credit score for loan program and pre-approval. So credit reporting is not perfect, right? I mean, the credit bureaus make mistakes, and part of the benefit of us reviewing the credit report with the consumer early on is much better to catch a mistake at that stage as opposed to when the clock is ticking because they've already signed that purchase agreement. Help ensure that the borrower is free from derogatory accounts, judgments, tax liens, collections. About every 4 months, if somebody hasn't found a home by that point in time, we're gonna re-pull their credit. Now this last bullet on the left really doesn't apply anymore, where it says the borrower will need at least 3 open lines of credit for at least 12 months. That's partially true, but the real metric is if a person has enough credit and enough of a credit history to generate credit scores, then they're in. They're good to go. Okay. Income. We're going to look at the income from the borrower. Debt to income ratios must meet minimum requirements. There must be at least 2 years of consistent employment or income. So that doesn't mean 2 years on the same job. Okay, it just means can we validate 2 years of employment? And just so we're not telling people no for the wrong reasons, an important thing to know is if somebody is new to the workforce, they've just come out of school recently, that time in college counts, or trade school, or whatever the case may be. So we have somebody and hey, I'm a CPA, been on the job for 4 months because I just graduated CPA school. That counts. That we've got our 2 years when we look at it from that standpoint. We'll ask them for their diploma and their transcripts, and that becomes that kind of a quasi prior employment verification.
Do you have a specific number for how low, like credit wise? Or does it vary person to person?
It's going to vary on the program. Okay, so when we look at conventional loans, and we might have a slide on this, but we can cover it now. 620 is going to be the minimum. With FHA government loans, we can go to 580.
Oh, wow.
Yeah, with MSHDA down payment assistance, and we'll talk about that. You have a 640 limit. So it's not so much driven by the individual, it's driven by the program. Okay, and sometimes we kind of back into that, right? I mean, if their credit is a certain level, we can only consider certain loan programs that are going to fit that. Okay. Assets. This often it trips up a first-time home buyer, and the question is, what do you need to know where my down payment is coming from? If I can bring my check to the closing, why do you care? Well, a person's investment into that transaction is their skin in the game, right? And that bodes well for the security of the loan. If somebody has, let's look at it from a bigger standpoint, a larger down payment, they've got more to lose if they default on the loan, because they don't get that down payment back, right? Conversely, when we look at the small down payment loan, 0 down, 3%, 3.5% down, we're going to want to be careful that all those other pieces are in place from a financial standpoint. Okay. So 11 loans you may not have known existed. So you probably knew that many of these have existed because this is kind of all of the programs that we have to offer. Conventional loans, that's kind of the cookie cutter bread and butter 30, 15-year fix that folks think about when they think mortgage loan. These are the loans that are purchased by Fannie Mae and Freddie Mac. You've heard of those entities. That really what those entities do is they keep capital coming back in the lending machine so that more and more people can obtain financing. Conventional loans are going to have the best terms, but because of that, they're going to have the most stringent credit and income requirements. Okay. FHA loans are not a loan from the government, by the way. It's a loan that's insured through a government program, okay? Flexible credit guidelines, FHA financing is a strong option for anyone who's experienced credit challenges in the past. Many times folks will think this is a first-time home buyer program, and many first-time home buyers will use an FHA loan, but you're not required to be a first-time home buyer, okay? You've probably heard the term maybe in your mortgage class, PMI. They talk about private mortgage insurance. FHA was really the precursor of PMI before it became a thing for conventional loans. Prior to that, if somebody wanted to finance the purchase of a home, the conversation started at 20% down. You know, that was the minimum down payment.
When did that switch over? Because I thought that was still, maybe I'm totally.
Well, it's interesting.
Conventional, I thought you had to have 20%.
No,
Okay.
and you know what? You're
Common,
super
Yeah.
common,
Yeah.
and it's been decades, Shauna, to be honest with you.
Really?
Yeah,
I wonder
yeah.
why the-
It's a pervasive thought. You are not alone. You are not alone.
Okay.
Yeah, so for whatever reason, that can't get unstuck
Okay.
from
So
whole
lowest down
country.
payment conventional would be
3%.
3%.
Yeah,
But now you'll have PMI.
You'll have
you don't
PMI.
get the 20%.
correct.
Okay.
That's correct. Yeah. And so when 20% was the only option, HUD, who administers FHA, stepped in and said, look, we need to do some things to spur home ownership. If a bank does a mortgage for less than 20% down, we'll insure that additional risk the lender is taking on, and we'll send the insurance bill to the buyer. Okay. That's abbreviated as MIP, mortgage insurance premium. You put it on a conventional loan, it becomes PMI, private mortgage insurance, but it's all the same thing. Okay. Renovation loans, we talked about this a little bit earlier. So this is when we're combining the improvement or rehab of a home in with the mortgage for the purchase. Okay, this can be a really beneficial thing that doesn't get used a whole lot. So the way I like to deck it up is you can finance repairs and renovations that are required, and also repairs and renovations that are desired. Okay, so I'll give you, for example, during the recession, when there was a great deal of foreclosures on the market, you see a home, it's maybe here in Shelby, boy, the price looks great. You go to look at it and stuff's missing, right? Kitchen cabinets are pulled out, plumbing is pulled out, things such as that. It's not financeable when it can't be, when it's not habitable in that fashion. A renovation loan can solve that by financing those required repairs. Okay. By the same token, and this is an important thing here in this market where listings are not as robust as we'd like them to be. You're working with that buyer, boy, they have to have that finished basement. They have to have a finished basement. And here's the other stuff that they want. And you come across a home and we're checking off all the boxes on all that other stuff, except there's no finished basement. It's like, geez, there's not going to be another one for this person to consider. A renovation loan can roll in the cost of that finished basement. Okay. So in a market like this, so important when a buyer finds an almost, and there's not 5 other things to look at because the listings are so skinny, you know, so renovation financing can help solve that.
I mean, it's not on a newer based home, right?
It's not on what?
On a newer home.
Not on new construction, but it can be a newer home.
It can be.
Yeah,
okay.
yeah,
I
yeah.
remember talking about that with you a while back.
Yeah.
Okay.
What can't be done, and I don't know if this is what we were talking about. One thing also that was prevalent during the recession is a builder would start a project and then run out of money. They can't finish it. And you'll see these on the market, a partially constructed home that's up for sale. What we can't do is that we can't finish somebody else's started project using one of these loans. Okay.
Now you could, for an example, with a new construction home, if a buyer comes in and it wasn't a finished basement, wants to finish the basement, they could use it technically?
They could.
Okay.
They could. Yeah.
Alright.
Yeah.
But if a builder just walked away and let's say a handful of rooms weren't done.
Yeah.
You could use it for that. Okay.
No. Okay, USDA rural development loans. Now, as we sit here in Shelby Township, the thought might be this doesn't apply to where we're at on the map, but it's closer than you might think. So RD loans, as they're abbreviated, so rural development loan. This is a zero down home purchase program. Is that applause? Am I hearing applause? Oh, Stephen, is that a video with applause? I thought I heard.
What is that?
Like a pencil.
Oh, maybe that's right. So what U.S. Department of Agriculture has done is they create a program to help incent home buyers in more sparse areas. But as urban areas have sprawled, those borders are closer than one might think. I think there's a chunk of Washington Township that starts to become rural development.
Yeah, north of 26.
Right, yeah, Romeo, up where I'm at in Oxford Township. So these fringe areas are eligible for that type of financing.
And
Now-
that's zero down.
and it's
Could
zero
be.
down, yeah,
Could be.
zero down, and you can, with an appraisal that comes a little high, you can roll in closing costs. So a home buyer can get in for very little money on this
So if I
program.
wanted an old farmhouse,
Uh-huh.
I could look at.
Absolutely. Yeah, now, where the name gets a little skewed is that what it's not for is the purchase of a working farm. It's gotta be a home that's, I know.
Doesn't come with a cow.
It doesn't come with a.
So, I mean, if it's 30 acres in a farm home,
Mhm.
but it's not being farmed.
Yeah,
Because there's tree, I mean, it's more like a treed area than.
Yeah,
You
that-
could-
that's
you could do the
acceptable.
rural development.
right, that's acceptable. That's
Now,
acceptable.
would you have to do a 20% PMI kind of thing on that, or no?
Well, there is mortgage insurance on an RD loan. In light of the fact that it's zero down though, it's really inexpensive.
It is?
Yeah. So it's a nice program, we have a tool, and I can share this with you, where you can just punch in a property address and it'll tell you if it's rural development eligible or not. Okay,
Okay.
so, we're closer to those fringe areas than a person might think. And when you think of consumers that are struggling to buy that first home, if they're open to, location, this is a program they need to know about, okay? First time home buyers, especially if they don't have children yet, so not necessarily tied to a school district. They say, well, we just want to stop renting. We want to buy a home. First time home buyers, in almost every case, the stumbling block is funds for the closing. It's hard to amass funds for a big down payment. So this is a nice tool. And you start to get into areas where just by location, you're going to get more home for the money, right? So.
So for me, it's like a lot, because it's in my area. But interest rates on that, are they pretty comparable to conventional?
They really
mortgage
are.
rate?
Yeah, we're in the mid to high sixes right now in
Okay.
that program. Yep. VA loans, exclusively for veterans. Again, the primary advantage of a VA loan, it's a zero down payment program. Okay. This, out of all the loans that are on here, the VA loan probably has more misunderstanding and myths behind it than any of the others. And it's really a shame, because we end up with, men and women who have given service to their country end up kind of being viewed as a second tier buyer to a seller or their agent because of misunderstanding of the VA loan. They feel it's more cumbersome, it's going to take longer, because it's zero down, it might be a substandard buyer. And none of those things are true. None of those things are true. In fact, from a default standpoint, VA loans perform better than conventional loans. So they're high quality loans. What happens is that lenders that don't do a lot of them stumble over them, and so that helps give a bad rap. I have a colleague at Roth, who does VA training nationwide, and his mission is, we gotta not let people think about this as a second tier type of program. I think you sat in when we had Mike Fisher.
Yeah.
So it really, it's helpful to know these things. And probably for today's conversation, the important takeaway is, we don't want to ever assume that a veteran knows that they have their benefit. Okay. Does anybody have relations that have been in the service? No? Okay. Well, one of the things that happens is, you have this period of time, could be a few years, could be a lot of years, where your world is 100% the military. That's all you know from the time you wake up to the time you sleep. And then when it comes time to go back into civilian life, you're given this 90-minute presentation on reacclimating, and it's like, okay, thank you for your service, off you go. And they get a stack of papers like this, as you might have managed that. It's like, okay, you're a veteran now, so this is you. Well, the very fact that they're even eligible for a VA loan is very easy to get lost in the shuffle. Okay. So if you come across somebody who was a veteran, you pose the question, have you considered using VA financing? It can get them closer to a home than they might realize, especially since you go zero down. Home ready and home possible loans, I like to present these as conventional loans, competition to FHA loans. So they're 3% down programs where FHA is 3.5% down. Those are particularly designed for first-time home buyers. And one of the things that is a component of those loan programs is when the potential home buyer takes a first-time home buyer education course, the cost of their PMI is reduced as a result of that. Okay, so it keeps a little more money in that buyer's pocket. And there's statistics that show that the default rate of folks that take home buyer education courses is less than those that don't. So that's where that all comes from. Jumbo loans pick up where conventional loans leave off. So a conventional loan, and like I described it, those are loans that are purchased by Fannie Mae and Freddie Mac. They draw the line at 726,200. Okay, now that line changes every year, but right now it's 726,200. Okay, if somebody wants a mortgage larger than that, it's considered to be a jumbo loan. And the primary difference is that's a loan that cannot be sold to Fannie Mae or Freddie Mac. Lenders typically keep those in their portfolios as opposed to selling them. A little more stringent guidelines, as you might expect, because the higher loan size. Okay, you're typically going 10% down, 700 plus on the credit score, that type of thing. Ross can go up to 2 million on a jumbo loan. I've never closed one, but you can do them if
Maybe one day.
you're right. So maybe one day. I think I did one.
I'm sorry, what was the number that you have to get to use a jumbo?
It's anything over 726,200.
Okay.
Yeah.
I'll tell you what, that's getting closer and closer every day.
Yeah, isn't that crazy? Yeah, for sure. On the surface, that sounds like a high number.
It is a high.
It is a high number, but then when you think,
Average new construction is over 500,000.
Yeah.
If you
Yeah.
wanted to bump it up to your next home, what is that gonna be?
You're there, yeah.
800,000?
yeah, exactly. That number gets adjusted every year based on really median income and median home price analysis that's done by the government. MSHDA programs. MSHDA is an acronym. It stands for Michigan State Housing Development Association. And what MSHDA does, it provides a down payment assistance plan to help provide seed money to first-time home buyers. It's not on there, but the amount is $10,000. It's substantial. Okay. There, as you might suspect, there are certain requirements that come in with that. And the most important thing, though, is that it's not a grant. It's not a grant. When a person uses that $10,000, that $10,000 goes towards their down payment and their costs and what have you. They've got to pay that back to the state, but they pay it back when they sell the house or refinance the house. In the meantime, there's no monthly payments on it. Doesn't accrue any interest, just kind of sits there.
Also,
Okay.
at the tail end, you gotta come up with 10 grand.
Yeah.
When you close.
When you close on the
Seller.
sale. Yeah, as a seller. Yeah. And there's obviously any low down payment program is going to have a certain amount of risk built into it. But if we take statistical things like people will stay in their first home 5 to 7 years, we've seen appreciation rates, anywhere from 4 to 10% over the last couple of years. By the time we hit that typical sell point, they've got enough equity to pay that money back to the state. Okay. I should really remove that next bullet, that down payment assistance. For us right now, that down payment assistance is the MSHDA program. That's what we use for that down payment assistance.
And you're okay with doing those loans, Tony? That's not a problem?
Yes,
Okay.
yeah, we do MSHDA. I'm looking at one for Lori right now, in fact, yeah. I'm gonna come back to guaranteed pre-approval because that's kind of a cool thing. Manufactured home loans. Now, again, are we going to see any in our immediate vicinity? Not necessarily, but you start to get even just a little bit of outstate manufactured homes get to be quite prevalent. The kind of informal term is like a double wide. Okay, it can be a single wide, but double wide is what's typical. The big difference, big line in the sand is we can't finance a manufactured home when it sits in a park where somebody is paying lot rent. Okay, but if that very same home had been plopped down on a parcel of land that the homeowner owns, now it's not in the mobile home park, it's personal property. When it's attached to real estate, it's real property. It's truly real estate. We can finance them then. Okay, and we can finance them on all the programs, VA, RD, FHA, conventional, whatever. Okay.
So it's kind of similar with us as agents, because we can't sell.
Yes.
So we just back those two.
Well, that's an excellent point. Yeah,
Yeah.
because it's you can have the very, very same model If it's sitting in a mobile home park, it's personal property. If it's sitting on a parcel of land that's owned, then it's real estate. That's when it can be financed. There's other stuff that goes with it, but that's the big fork in the road with that type of a property. Okay. Guaranteed pre-approval. I'll close with this one on this slide here. So, this came about as the market turned into the market that we're in right now, where sellers are getting multiple offers on their properties, or kind of cherry picking which one looks like the best offer, and so on. And so what we do with our guaranteed pre-approval, when we do I'll back up to a standard pre-approval. When we do a standard pre-approval, we use automated software that's provided by Fannie Mae and Freddie Mac that analyzes credit, assets, income, and gives us that green light on that borrower. Okay. Even when we use that, though, a human being still needs to pick up the rubber stamp and hit approved on everything, right? That's called the underwriter. With the guaranteed pre-approval, I'm sorry if it is. It is. With the guaranteed pre-approval, I'll back up a step. That human underwriting phase typically only happens when you have a bona fide contract at work, a signed purchase agreement, appraisal, so on. The guaranteed pre-approval, what we do is that we take that pre-approved buyer and we'll put it in front of that human underwriter, the one who has the authority to approve the funding and issue the clear to close. We'll have them look at the file and approve it before they find the property. Okay, so it's just kind of like a pre-approval on steroids, if you will. Okay, but we back it one step further and we give information to the seller that says, Mr. Seller, if this transaction doesn't close, because we have this buyer as a guaranteed pre-approval, we're going to write you a check for $1,000. The idea being, on that universe of offers that are made that seller is considering, we want your offer to rank a little higher because it's got that little extra punch to it. So it's maybe not quite as attractive as the pure cash offers, but more attractive than all the other standard pre-approvals that are out there. Doesn't cost the buyer anything additional other than their time to get us the stuff necessary to make it happen.
Give you all the financial information.
Exactly, right. Okay, so a lot of this is going to be redundant, so I'll move quickly here. Conventional loans, like we said, these are the loans that are secured and purchased by Fannie Mae and Freddie Mac. 726,200 is the maximum loan limit. Minimum credit score 620, like we had talked about before. Now this says minimum down payment 5%, but again, that home buyer and home ready program are conventional programs. Those will go to 3% down. Okay. Maximum debt ratio allowed is 45%. And basically what we're doing with debt ratio, we're looking at, Mr. Buyer, what is your income? What is your existing debt? What is your existing debt plus that house payment, PITI, with taxes and insurance? And we don't want that to exceed 45% of their income. Okay. PMI is based on credit and is removed once the loan to value reaches 80%. Loan to value is a term that you hear us use. It's nothing more than the inverse of the down payment. Okay, on a 20% down payment transaction, the loan to value ratio is 80%. Okay. Interest rates are priced based on credit rating. In fact, I would say that for conventional loans, interest rates and PMI are impacted by credit more than any other loan program.
Now I have a question. Now, when you have PMI and you reach 80%, do you have to refinance in order for that to go off, or will it automatically drop off?
This gets interesting. Okay, it automatically drops off at 78%.
That's what I thought. Okay, that's what I
Okay,
heard. I wasn't
yeah.
sure.
Now
Okay.
that's if you totally turn your back on it
Yeah.
and don't do anything, it'll drop off at that factor. If you hit 80%, you made extra payments on your mortgage, whatever the case may be, then you call the servicer and say, hey, I'm there. I'm at 20% equity. Yeah.
Okay.
A person can refinance and have it done if they wanted to as well. So if they can kill two birds with one stone, I'm refinancing because I'm lowering my rate and I'm removing my PMI. That's when a person would refinance to both lower the rate and remove the PMI, but you don't have to refinance to remove the PMI.
Okay, makes sense.
Yep. Let's see, primary residence, second home or investment properties. And so it's not just primary residence that will finance. Second homes anywhere in Michigan here, investment properties, anything up to 4 units is what we can finance. So a fourplex, duplex, those types of things. Anything more than 4 units becomes a commercial transaction. Okay. Again, 2-year work history, able to source funds to close. which can be liquid, non-liquid, and gift funds. All the loan programs that we're going to offer are going to permit gift funds, which is assistance from a family member. The exception being is if somebody is buying an investment property, then gift funds are not permitted, and jumbo loans, okay? So, and you kind of look at that and say, yeah, if somebody's buying a rental property or someone's buying a $900,000 home, gift funds probably shouldn't be a part of that conversation.
So I'm sorry, quick question
Yeah.
for you. If I had 5 investment homes, that would be considered commercial?
No, I misspoke, I guess. So five
I may have misunderstood.
individual single-family homes would all be residential transactions.
Okay.
But if you have a building that has 6 apartments in it,
Oh, okay. I
yeah,
get it.
so
Okay.
it's the number of residences under one roof is the way you can look at it.
Okay.
Yeah.
Hey, Tony, 2 years, just to refresh my memory, somebody's coming out of college and they're getting a job, is that something you can work with?
Absolutely. Yeah. In fact, when you had stepped out, we brought up that example because that's important, you know,
Okay.
especially with first-time home buyers. It doesn't have to be 2 years on the same job and you know, shorter than 2 years on the job with a training piece behind it works. Okay. And again, it doesn't have to be the college degree. It can be somebody getting their nursing certificate, somebody coming out of trade school, those types of things. Okay, so FHA loans, we touched on this a bit already. Kind of a precursor of the government stepping in to help people buy a home when they couldn't otherwise. They allow more lenient credit standards. They allow higher debt versus income ratios. There is a limit here in the Tri-County area. $472,030 is the maximum FHA loan. That much like the Gamesha limits, it's adjusted every year. Okay, that says minimum credit score is 600. I need to amend this slide. We'll go to a 580 on the credit score for an FHA. 3.5% down payment, maximum debt ratio, about 49% is where we'll go. PMI, or more accurately MIP, when it's an FHA loan, it's going to be the same cost regardless of a person's credit score. Okay, more expensive on a higher loan amount, less expensive on a lower loan amount. Okay, now FHA is only primary residence, and you have to have a 2-year work history, but we've talked about that as far as what defines that work history. One thing that is unique on FHA, can only have one FHA loan at a time. Okay, you don't have to be a first-time home buyer, but you can have 2 outstanding FHA loans out at a time. There's exceptions, like if there's a transfer or job transfer, FHA will permit 2 FHA loans. If they'll say change in family size. So if a husband and wife and 1 child are living in a 800 square foot home and new baby on the way, and oh, it's triplets, they'll permit another FHA loan into a larger home. So VA loans, again, I'm not going to go bullet by bullet because we did kind of cover this. 0 down for veterans, active duty or retired veterans, or the spouse of a veteran where the veteran died as a result of a service-related illness or injury. Okay. There is no maximum VA loan amount. Okay.
Oh, wow.
Yeah, that's a relatively new thing. DTI and credit scores, that is lender by lender. We want that credit score to again be at least 580. There is no PMI on a VA loan, even though it's 0 down, although veterans they do pay into what's called a funding fee. It's not an add-on to a monthly payment like PMI is. It's financed into their loan at the time of closing, so it's not a cash out-of-pocket thing. But if a veteran is disabled and VA will evaluate disability in percentages, 10% disability, 20, whatever, any percentage of disability, and the veteran is exempt from that funding fee
Is that
altogether.
still 2.25%?
Yes, for first time use. It's 3.5 for second time use.
Oh.
Yeah, it gets expensive.
Wow.
Yeah. Only primary residence for a VA loan, but you can have more than 1 VA loan at a time. Okay, that's where they kind of diverge from FHA on that part. The closing costs are going to be lower in almost every case. In fact, at Ross, we don't charge there's no fees coming to the lender. Okay, the closing costs are just the third-party fees. The appraisal, the title, credit, recording fees. We don't charge any origination, no processing fees, no admin fees or anything like that on our VA loans. Now, we talked earlier about if have a listing and you're vetting or grilling that lender as to the quality of the pre-approval letter on a VA loan. If you get a pre-approval and it says that they're using VA financing, the critical question is, have you received the veteran certificate of eligibility? Okay, certificate of eligibility is issued by the Department of Veterans Affairs, has nothing to do with the veterans' finances. It all has to do with their stint, their time in the service. Okay, and did they do the sufficient time in the service to become eligible? So where lenders get into trouble is that they'll vet all the other stuff. Credit score's fine, income is fine, assets are fine, job history is fine. We're going to pre-approve this buyer, and then they run the certificate of eligibility at the end. And they find out for some reason the veteran is not eligible and the whole deal dies on the table. Okay. Takes about 30 seconds for a lender to get that certificate of eligibility and the cost is zero. So if they don't have it, you don't have a pre-approval. Okay. All right. Another cool thing is that VA loans are assumable, which in this market is kind of an interesting thing. So right now, out of the box interest rates might be 6.75%. But if a veteran wants to sell his home and he has a VA loan on it at 3.5% that a new buyer can assume, that home's a little more valuable because it comes loaded with that low interest rate. So it's kind of a cool thing. You don't hear of it a lot, but if it, let it kind of prick your ears up if you do hear talk about that, either from a seller or if a buyer asks about it. It's one of those things, the stars have to align, okay? Because when a person assumes the loan, the down payment that the buyer has to pay is the difference between the loan balance and the sale price, okay? So if it's a veteran that bought the home 2 years ago, he probably doesn't have a lot of equity in it if he did zero down. But if he bought 10 years ago, you might have a $300,000 sale price and a $200,000 loan balance. So yes, they can assume that 3% loan, but they got to make a $100,000 down payment. All right, renovation loan. Again, we talked about these a little bit earlier. There's two flavors, if you will. There's the FHA 203K, which is it's a part of that FHA program that we talked about earlier. So it's a government-backed loan, and then Fannie Mae offers a home-style loan program. There's more similarities than differences. There's certain down and dirty details as to why we might choose one or the other, but there's more similarities and differences. Now you want to see that that minimum credit score 640 because there is some additional risk. We do have a minimum loan amount of this with $75,000, and really what happens is that if you have a transaction where the dollar amount is smaller than that, the financing, the numbers stop making sense. The cost is too high for the amount of renovation funds that a person is going to get. One important thing is that third bullet point, the work must be done by a licensed and insured contractor. So what renovation loans are not is a tool for a do-it-yourselfer. Okay, so that's a super important thing. Basically, what we do is we're going to get bids up front with the breakdown. Money can be dispersed at the time of closing if somebody needs to buy their material to pay for a contractor. It's kind of a cool thing because the buyer is choosing their contractor, they're choosing their own stuff, their colors and materials and what have you. So it's really an opportunity for a buyer to kind of customize the home that they're seeking to purchase. I had another thought with that licensed contractor thing and it just left me.
And that's all wrapped into the same loan. It's not
Yeah.
like a separate line of equity or anything like that.
Correct. So it's the same loan. It is kind of broken apart. So let's use a real round number example. Someone needs $100,000 to complete the purchase and their renovation is $25,000. So at the time of closing, that $100,000 is dispersed and it goes to the seller. So now the seller can go away. They're done. They're out of the equation. That $25,000 is set into escrow and it's dispersed as work is completed. Okay.
Oh, okay.
But it's not two separate loans.
It's not a separate payment
Correct.
essentially for them.
Correct.
So they're still paying a loan at 125.
Correct.
The
Okay,
money sits there until the work's done.
Correct.
okay.
Interestingly, and we're careful with this, you can finance the first 6 house payments back into the loan if the need arises. And it's like, well, geez, we're financing on top of financing. Why would somebody do that?
Crazy.
Well, sometimes the home that's being renovated can't be lived in.
Yeah.
Okay, because of the scope of the renovation. So they're living somewhere else and probably paying to live somewhere else. And this is a way to minimize having 2 house payments where you can only live in one of them. Okay, but they're a neat program, neat program. Okay, home ready, home possible loans. Again, you can think of those as the conventional variant to an FHA program, 3% down, first time home buyers. And by the way, that third bullet point there, we don't define a first time home buyer as somebody who has never, ever, ever purchased a home. It's somebody who has not owned a home in the last 3 years. Okay. Home education, home buyer education course is required. Now it says PMI is higher on this program versus a 5% down. That's not entirely true. Because there is a discount with that home buyer education program.
This is different than
Play.
3% down conventional basic loan,
It really is.
Okay.
That's what it is. Yeah,
so it's more for a first time.
correct. Yep. Jumbo loans, again, anything over 726, 200. Minimum credit score is 700. This says minimum down payment 15. We can do 10% down. Debt ratios are going to be a little more restrictive. No gift funds on those jumbo loans, and we look for reserves. Reserves are nothing more than money left over after the closing. Okay, which kind of makes sense when you're in that price range. It should be,
I would hope you have. some-
yeah, the bank account shouldn't be down to zero when they move
Can they
it.
use retirement accounts or anything like that?
Yes, as long as they have access to it, really.
Making
Yeah.
a very bad decision if you
Oh,
are buying
goodness
that.
gracious.
without
Yeah,
being covered.
yeah. Interestingly, a lot of homes in that price range sell for cash.
Yeah.
It's really,
Wow.
yeah, and we're at a point now where cash is at its highest level as far as a percentage of all the transactions. I've been doing this for 32 years. And for the first 20 years at least, cash transactions were under 5% of the total. Now they're 27%.
Wow.
Yeah, nationwide 27. I don't know where the cash is coming from.
I was
don't
just
have
gonna
it.
say, I wonder why.
I feel like people bought houses a long time ago. Like my mom got her house in 2012 for $30,000.
Oh,
She paid
yeah, right.
cash, and if she sold it now, it would be 200,000.
Sure,
And it
yeah,
should go
yeah.
into something smaller.
The appreciation
Yeah.
feeds it for
Yeah.
sure. A lot of, another thing that's happened is as the market has been so constricted as far as available properties, and there's the knowledge that a cash offer will often trump a financed offer, families will pool money.
Yeah.
And because then what you can do, buy the home for cash, close, then come back to me and put the mortgage on after the fact, reimburse parties for their
Oh, so you
cash.
took out like an equity loan?
Well, it's a cash out refinance really, but it's this, the end result is the same. You know, you borrowed against what is 100% equity in that home.
Hmm.
Yep. Okay, so there's guaranteed pre-approval. This is just examples of some of the collateral. By the way, I'll send you guys this PowerPoint, so.
Oh, good. Okay, I was just gonna ask.
Yeah, like to remember all those
These
great
numbers.
stuff.
I write it down anyway.
Yeah. I know I was watching you, I'm like, oh, I've done that.
So what we'll do, that first letter on the left, this is my colleague Tony Thwaite. She manages our branch in Birmingham. I guess they decided she was more photogenic than I am, so she's on my slides here. But that first letter is the one that is presented as seller, says, hey, you'll get $1,000 if we don't close. And I've done two with Anna Stronach here in the office that truly made the deal. The offer was accepted because of that guaranteed pre-approval. Okay. And we provide a little bit of resume information to show how long the loan officer's been in the business. When I send you, I'm going to send you a few things, the RD home search tool, this PowerPoint. I'm also going to send you another link. And on any correspondence from a lender, you're going to see an NMLS number, National Mortgage Licensing System. Okay. And there's an online search tool. Anyone can use it. You don't need to register or anything like that. And you can get the history of the loan officer.
Ah,
And there's some compelling things, you know.
interesting.
It's like somebody hears no, and then some lender says, yes, I can do the deal. I encourage agents to, just track that NMLS number and see what you see, and you'll see, 6 months at the lender and then Starbucks, McDonald's, and
Right.
not to be derogatory with somebody, but you have to kind of look at the whole picture
Yeah.
and say, how sure are you?
Right.
Because not that the person was doing anything underhand, they might just be making a mistake, and
Right.
you kind of want to know.
Yeah.
I think that is it.
Hey, there you are.
There I am.
So photogenic.
Thank you. Thank you. Well, in my rented suit and everything. But we're very fortunate to have the relationship with Century 21 Town and Country. We of course are thankful, and we want to get as many referrals as we can from agents on the buyers. But we absolutely do not take it for granted. And we want to help you shine and help you look good. We want to make sure that the buyer gets up in the closing table and says, wow, that went pretty darn good. Because that's where the referrals come from, when there's an experience like that. So we take it, we take this relationship very, very seriously. So, that's that. That's
I
that.
have a question.
Yes, by all means.
Do arms still even exist?
Arms exist.
They do still.
They
exist.
do. Adjustable rate mortgage
Yeah.
is what Jen is talking about. They do. There's, you want to get in the weeds a little bit with some financial
No, I was just
explanation?
curious, 'cause That's what got us a lot in trouble, right? Back in the day. a little bit?
To an extent,
Because it's not a fixed rate, right? So
not a
it does.
fixed rate.
Yeah.
yeah.
So after so many years, they
Yeah.
could skyrocket, like maybe
Well-
at 2 or 3%, and it would get up to each so many years, it goes up a percent or something like
They're
that.
capped,
Yeah.
they're capped, and so what a conscientious home buyer can do is know their worst case scenario, see if this makes sense. Some years back, when there was a lot of transferee activity, especially in the big three, and somebody knew they were coming to the headquarters for a 4-year project, they didn't need a mortgage that was fixed for 30 years. They will never see the end of it, so they might get a mortgage that's fixed for 5 years or 7 years, for as long as they have the loan, it's fixed, so they play a role, but they were abused during the recession.
So you can get it fixed for a certain amount of time and then after that is how it.
Correct,
Okay.
correct.
Like you refinance.
Okay.
It's super hard to find logical rates on those right now. And in a conventional setup, I'll think back when, in my earlier years in the business, because we probably did half adjustables and half fixed. So a fixed rate loan, might have been at, say, 8.5%. And then a loan that is fixed for 3 years might have been at 5 and 7/8%. That's a measurable spread.
Yeah.
And just like with the logic of investing, there's some risk versus reward that's looked at with that kind of thing. And a person kind of projects out, how long am I going to own that home? Does this whole thing make sense? Now, in many cases, the adjustable rate is the same as a fixed rate, and in weird cases, even higher. So
Wow.
it's a qualified yes that they're out there.
Mhm. But who would?
Who would do it?
Yeah,
right.
Yeah. Now, every now,
They make it more challenging.
well, here's, and this is where I was saying we can get in the weeds a little bit. So every now and then, if you listen to the financial news, you're going to talk about the yield curve. Okay. And the yield curve is nothing more than, you'll see this represented sometimes at the sign on the bank. You can get a 6-month CD for this rate, a year CD at this rate, and 5-year CD at that rate. And the idea basically is the longer you let the bank hold the money, the higher the yield that they'll pay you. Okay. And the US Treasury does the same thing with T notes and T bills and T bonds. Okay. And then in a typical situation, if you buy a T bill, the rate might be down here, and a T bond, the rate might be up here. Well, lenders hedge profits based on what's happening in the economy. Okay. And so they'll stake the rate of an adjustable rate loan based on the same length of that treasury security. Okay. So,
Who's on our participants? Just curious.
oh, that's a good question. Let's see.
I don't know.
It's here. Up there now. How come I can't? There I am.
Bring up, attendees,
This one?
just click on it.
Okay. Hey, it is Tom. Oh,
Tom,
and me.
all
Hi,
right.
Tom. Hi, Tom. And I'm the other one, I guess. Yeah.
Here we go.
So what's happened now, as there's concerns over recession, we hear it in the news from time to time. Well, then what happens is that what they call the long end of that yield curve goes down and the short end goes up. It's inverted. And so if you're staking your loans, so like an adjustable rate loan that's fixed for 5 years, is kind of staked against that 5-year treasury. Well, if the rate's higher than the
Right.
other ones, you end up with arms pricing that's out of whack. They're out there, and every now and then you might see a credit union or a mid-sized bank offer something that looks attractive, but they're hard to find en masse. They're a little bit of a unicorn right now. And the spread between the fixed and the arms are either not at all, or it's very, very small, but the risk is the same. So why
Yeah,
would,
I'm trying to attract somebody.
Yeah,
They're
so
not.
why do it?
yeah, they're not. They may come back. We'll see.
Well, I mean,
Um,
yeah, there's always tomorrow.
It's always
What is-
tomorrow.
You might have already said this, but what is what are the rates right now?
So a plain old vanilla 30-year fixed rate loan, you're trying to get about 6 3/4.
Okay.
Yeah. So, you'll hear buyers talk about how outrageously high rates are right now.
Yeah.
It's all relative.
It is.
We were spoiled with this window of time where rates were in the 3s and 4s, but that was a really unnatural occurrence.
You know,
If you look over the last 3 decades, rates in the 6s look pretty darn good
Yeah.
compared to where they had
yeah,
been.
it was over 7 ever.
Oh, yeah, absolutely.
I was just
absolutely.
gonna say, what was the average? It was over 7?
Over 7 for sure. But we have a subset of home buyers who could be sellers. And when they're weighing the pros and cons, one of the cons to selling is I got a 3% mortgage. When I sell this house and buy a new one,
Right,
I'm gonna be deep in the 6s.
right.
So what's the talk track on that?
The talk track is still for rates to come down into the 5s.
Okay.
Hopefully by the end of the
No,
year.
when you're talking to somebody that could be a
Oh,
seller
oh,
and they're not.
oh,
because
okay,
they're worried
yeah, good
about
point.
going to a higher interest rate.
Yeah. Well, so there's a couple things. There's a tongue-in-cheek clause or statement where people say, marry the house, but date the rate. Okay, and what that means is, when you're buying the home, that mortgage may not last the whole life of your home ownership. You can refinance, you can do other things. Now, let's state the obvious. There's a gamble to that. We can tell a potential buyer, you can refinance later, but we don't know that for sure, right?
Mhm.
It might come down. We think it.
They might come down, yeah, and there's indications that they will come down, but we want to be careful with. I've been doing this for a long time. I still stay out of the arena of predicting interest
Yeah,
rates.
sure.
They're fickle and they're going to do what they're going to do. But the reality is, let's flip this over. Rarely do home buyers get a 30-year mortgage and see it to the end. Something happens. And if somebody is 8 or 9 or 10 years into their mortgage and they say, well, I got this 3% mortgage, the reality is they've already paid the chunk of the majority of their interest already, so the fun is kind of over as far as, now you're paying more principal. That's not a bad thing, but it's not like you're still basking in this cheap money. You've paid the tab for the money. That's done. So, and the other thing is, there's a quality of life conversation. If you go back to that family soon to be of 5 with an 800 square foot home, they might have the low rate, but they're probably going to kill each other.
Right.
If they're too
Yeah.
long, right?
Right.
So it's step back and say, all right, what are you looking for in the home? Here's the payment. Is this comfortable for you? Not to, I'm careful to make sure we don't sound too much like used car sales, but the reality is we don't deposit and withdraw interest rates. We deposit and withdraw dollars.
Mhm.
And if somebody can get the home that they're looking for to meet their family needs and the payment is making sense, that's really the essence of what should be happening. If you're sticking with that 3% rate, but you're miserable in your home,
Yeah, it's not worth it.
it's not worth it. It's your home. I mean, you have.
There's give and take in both
There
scenarios.
really is,
Yeah.
there really is. And so, does that always justify going into the higher rate? No, but it justifies a conversation. Let's see what you can do. Because here's the other part of that equation. If that person is sitting on a low interest rate, he's probably got more equity than he thinks. Right? Because we've seen some nice appreciation over the last handful of years. And sometimes that's an eye opener for sellers, like, whoa, I can get this much out of the sale of my home. I can buy a little more home than I thought. And the payment won't be as high as I thought because of that larger down payment, So we want to help them peel back the onion on that and not just fixate on the interest rate. We have a lot of people here, I shouldn't say a lot, but we have a measurable number of people right now that are refinancing their homes. I'll use round numbers, out of a 3% loan into a 7% loan so they can take cash out and pay their debts. Okay, what are we hearing in the news? Credit card debt is at an all-time high. Okay, average car payment right now, I don't have the number, but it's north of $500 a month, and so people are having cash flow challenges right now. And when they're having a challenge, they're having a challenge. And if that means, yes, I'm going from a 3% to a 7%, but my cash flow is improved by $900 a month, that's a real number. That's a real number. So,
Everybody's in a different place.
yeah, for sure, for sure. And then what we can do to take the sting off of that, if somebody is saving $900 a month, well, let's take 250 a month of that and start overpaying on that new mortgage at the higher rate. Now you've diluted the impact of having a higher interest rate mortgage. And you may end up having that same payoff date in the future as your old loan. So the point being is that we want to have conversation with consumers on this kind of thing. And give them guidance, be the consultant for them. So that they don't make their decisions based on what they see just on their first Google search, right? And Steve will attest, and you'll get to know me. I'm not a high pressure guy. Okay. I always think about the poor people that get pulled into timeshare presentations. and they bolt the door. You can't leave until you hear the whole thing. Well, that's what
What are
we're
you not
about.
gonna buy?
Yeah, exactly. Right. Sometimes the conversation is, yeah, you probably should wait a year, but that doesn't mean they're not a customer. It just means they're a customer for another day.
Yeah.
And while they're waiting a year, how many people might they say, you know what? I talked to Hannah and I talked to Tony, it's not time for me, but they were really straight with me.
Yeah.
And you get referrals out of it beyond the one that's gonna happen in a year,
Yeah, it's about what's best for them, not us,
for sure,
always,
for sure.
forever.
Yeah. I always tell people that, working for a smaller lender, I need to be prepared to run into you at Kroger. And I want to know that I've treated you right.
Yeah.
Yeah, that's always,
Yeah.
you will run into people too.
Yeah.
What's their name again?
Yeah. Oh,
I
for
don't-
sure.
names
Yeah,
are so
yeah,
bad.
yeah. I mean, my goodness, you had to remind me. I recognized you, but it was.
Yeah, you
the name.
really, I could tell, I was like, you introduced yourself, but it was, you were hesitant.
Yeah. But we can hold our head up high when we do business that way though, and say, yeah, I treated that person right, or gave them true, honest guidance about home ownership that hopefully helps them down the line. So,
Yeah, and I mean, case in point, here Tony is, I don't know, 20-some years later, still doing what he's doing.
yeah,
He's
Romy,
done multiple things. I've seen him forever, but.
Yeah.
And then me too. And people in this company, I think generally treat people the right way
Yeah.
and do it the right way, Dad.
Oh.
I mean,
yeah,
come on,
that's great.
she was my mentor.
Yeah,
if
she's
you
great.
say.
yeah,
Yeah,
So,
like doing business with your mom,
Yeah.
you gotta remember that when you're in this business, what you do today affects tomorrow, either a positive or a negative way.
yes,
So
for
we
sure.
want it to be positive.
yeah.
So-
Referring someone to Tony is always a positive.
Thank you, Steve. I appreciate that. So in closing, you use me as a filtering mechanism. If you get that buyer on the phone, send them to me, let me qualify them for you. And you can evaluate a couple things. Number one, what price range should they be looking in? And number two, are they serious buyers? And the goal being, your time is precious. You want to use it appropriately. And not that we want to be cherry picking which buyers we're going to work with, but we don't want to waste our time either, so that's what we're here for.
Thank you.
You got it.
Absolutely, great job.
You're not a rookie. Was this helpful?
Yes.
Good.
It's helpful for me.
It
It's just a
is,
refresh.
but yeah, it's a refresher, I learned this in school, but honestly, it's been so long. Cause my deals that I've done have been cash.
Oh, what a shame, huh?
So, oh, it's nice.
Yeah.
How unfortunate for you.
Yeah,
They were quick, they were cash.
So